The S&P 500 and other indices have become less diversified in recent years and pose risks to investors. There are some points worth noting. As of September 30th of 2023, 7 companies represented about a 28% weight, and 35 companies represent over half the weight of the S&P 500, where stocks are weighted based on their market capitalizations. The information technology stocks have surged to represent over 28% of the index, with Apple and Microsoft each at about a 7% weight. As a result, the S&P 500 has become top-heavy, with concentrated weightings in a few companies with higher valuations and betas. The overall index has become potentially more volatile, with the increased exposure to the stock-specific risk to these few technology names. Any negative news in one or two of these companies could disproportionately skew the performance of the index. Market cap-weighted index funds reflect several risks to the investor, including irrational market behavior, for example, the internet bubble of the late 1990s, a lack of guardrails to control individual stock or sector exposures, and sector volatility. Overpriced stocks are overweighted, reflecting pricing inefficiencies, and greater weightings to the largest companies. Glenmede Investment Management utilizes active equity management. An active manager can reduce some of the risk of indexing with quantitative tools, evaluation discipline, fundamental research, and portfolio optimization techniques. A portfolio manager can prudently select equities to create a well-diversified portfolio that is appropriate for the client and not own a stock just because it is a member of an index. The characteristics of an equity portfolio can be customized to complement the client's overall asset allocation mix in meeting long-term return and risk objectives. An active manager can manage the individual equity holdings to reduce the investor's tax burden. And a discretionary equity portfolio can also reflect a client's preferences for socially responsible or environmentally sensitive companies. These advantages should allow an experienced equity manager to reward the investor with higher returns and or lower downside risk versus passive index funds.